Hello, everybody, and welcome to the second quarter 2026 macro outlook. I'm here with my team member, partner, and fellow well-met, James Maxwell. James, how are we doing today?
Doing well. Happy start of Q2 here.
I like it. It's racing through here. That is for sure. So I know we have a lot of things that happened during the first quarter that we'll talk about from an attribution standpoint, and then like the slide is entitled here, titled Macro Outlook. We will talk about what we think for the outlook for the upcoming 3-6 months here. So with that, let's jump into this. Obviously, this is Main Management, San Francisco-based RIA. Two features about us that we always like to point out. 10% of the firm assets are partners, so we are invested right alongside everybody. And of the 27 team members, half of them have equity, so a unique feature. I see you put a new flag in the timeline there with the launching of the Main Custom Model Partnership, which was June of 23, so we're about to lap our third year, which has been a very, very good value added. I know we get all kinds of positive feedback from advisors. So any of you advisors who have not taken us up on this custom model partnership, please reach out to your sales team or any of us. All right. And the next piece we have here are the investment team. You can see we have a lot of depth on the bench. We feel very good about this team. This team, just for all of you advisors wondering about it, we meet on a regular cadence of once a week, but obviously the other 6 days of the week, we are acutely aware of what's happening in the strategies. But you need to have kind of a formalized cadence, and that is what we have with the 5 of us meeting on that regular cadence. And the 4 kind of pillar pieces of our firm: cost, trust, we are in the trust business; price and proof, that just means that a lot of times when things are exceedingly high, maybe it's all been discounted, or conversely, when they're on their, on the basement, that once again, maybe everything's been discounted. And it's time in the market. All right, let's look at the attribution from the first quarter. James, why don't you talk a little bit about the asset class and then drill down to the sector size and give us kind of a flavor of what happened?
Yeah, the big story, obviously, the first quarter was oil and broader kind of commodities. You saw that in the quarter return, up 40% for that index, up way ahead of basically everything else. Equities broadly kind of suffered. U.S. equities, S&P 500, down on the quarter. Obviously, the past couple of weeks here, we're recording this on the 23rd. You've had some rebound. Now, U.S. equities are near or at all-time highs, but during the quarter itself, geopolitical tensions and everything going on with energy prices obviously helped the commodity sector, but hurt everything else.
Big time. And what about when you drill down to the sector side?
Yeah. So if we
How does that look?
Moving to the sectors here, just like I was saying, commodity sensitive areas like energy, all those energy companies in the U.S. did exceedingly well, up 38% during the quarter, and relatedly everything else kind of mixed. Things that are also commodity sensitive like materials, utilities also did well, but not nearly as well as energy did on its own. I also want to highlight the leading sectors for 2025, which were communication services and infotech, largely kind of this broader kind of mega cap tech complex, which did well from AI, kind of the broader CapEx. Those got hurt almost, they were some of the worst sectors this first quarter, broadly kind of linked to higher input prices, kind of fears of just broader economic slowdown. But again, looking at the past few weeks, those have rebounded considerably.
It's interesting. It's not on this slide, but you show energy up 38% in the first quarter. The earnings estimate for the full year is up 36%, 37%. And a lot of that got revised up heavily during the month of March, obviously, with what's happening over in the Middle East. Okay, great. How about oil? I
Yeah.
look at this picture, and for those of you that are in listen only mode here, you've got the price of oil that's gone north by northeast
Mhm.
because of the war. So maybe just talk a little bit about the implications from this.
Yeah. Left-hand chart, as kind of the headlines have all talked about, the Strait of Hormuz, the number of tankers passing through that on a daily basis. Basically, you've been all the way down to zero for a couple of weeks there. It's been slowly ticking back up. You can kind of see the latest reading around 5 daily average over the past week. You've had kind of this on again, off again, closure, stoppage, blockage. Um, I think the way that we view it in relation to oil and then broader markets is usually with these geopolitical
Mhm.
conflicts. As soon as you start to see the light at the end of the tunnel of, okay, the bombs have paused temporarily or whatever, the attacks have paused, there's starting to be negotiations. That's usually when the market's starting to look through it. Before that, there's still the kind of cloud of uncertainty that you don't know exactly how long this conflict will last. Now you're seeing some of that resolution start to happen, and then the markets obviously took advantage of that. Oil is down now. It's kind of chopping around, and then broader kind of equities are obviously at the all-time highs, like we just
Yeah.
discussed.
I like to say the bid ask on this for the Strait of Hormuz is the US and the rest of the world wants it to be a free passage
Yep.
zone. And Iran's ask is, oh, no, 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 we want to be
Hmm.
the toll keeper
Yep.
and taker for that matter. In fact, yesterday, I think they charged a ship a toll for passage, though it was not disclosed what the amount is. But
Hmm.
that's sort of what the negotiations are going to come down to. Do they have the right to be able to, or the ability to be able to collect a toll?
Hmm.
So stay tuned. All right. This is very interesting. I look at this consumer spending and oil sensitivity, and this is a long dated picture going
Hmm.
back to 1960. But you can see back in the late 70s, early 80s, when the energy and food as a percent of total expenditures,
Hmm.
they were 23,
Yep.
24%. They're down about 50% to
Yep.
10.7%. So maybe talk a little bit about how that impacts the consumer. I can tell you one thing, like the price of gas, we all panic here because it's, well, in the US, it's $4, but if
Hmm.
you're in the People's Republic of California, it's approaching $6.
Hmm.
But if you look in Mexico, which obviously has a lot lower standard of living and disposable income, gas is $6 a
Yep.
gallon.
Yep.
If you look in Germany, it's $8 a gallon. So maybe talk a little bit about that, how that impacts and how the consumer's a little more protected.
Yeah, I mean, this is one of those measures that a lot of economists will look at across the world and use it as a way of measuring kind of overall, how much people are spending on necessities versus discretionary income. Food and energy obviously being, two kind of necessities, staples that people need to buy, kind of regardless of the economic environment. And it's a good sign that that's come down over time. A lot of that's coming from just higher incomes overall, higher productivity, also on the U.S. economy side, being a net exporter of oil, also helps on that. But overall, what it says to me is that these oil spikes are just less impactful to the overall economy than they would have been in the 70s or 2000s when you had geopolitical conflicts. Obviously, the U.S. at that time, for a number of reasons, on the consumer side, having it as a higher share of expenditures, and also on the producer side, just not having the infrastructure built out here domestically, it was just a much larger shock to the economy. Now, I mean, it still obviously impacts the
Yeah.
economy. There's still the headline sticker shock at the pump, or impact on agriculture, on food, on fertilizer, things like that, but smaller than it was, say, 50 years ago.
Yeah. And what happens too is consumers, unfortunately, what they do when they see the price of gas,
Hmm.
they forget to adjust that for their wages that are going up.
Hmm.
So they're like, oh, $4 a gallon,
Yeah.
what is up with that? I remember when I used to pay 3. But what they don't tell you is, oh, I get paid
Hmm.
$38 an hour
Hmm.
today, and I used to get paid 15. That
Yeah.
part doesn't go into the equation, but luckily we've got you here to keep us real. So, all right. If we now look at, this is the Federal Reserve, maybe I'll just take this here because the green line is the 3-year forward inflation expectations. And you can see that you had a spike up in that when we had the inflation, which in June of 22 was 9.1%. Okay, it was insane. The Fed was behind the curve, but you still have these inflation expectations that are kind of drifting around right below 3%. What that tells me is that your Fed funds, which are now at, call it roughly 3.6%, they probably aren't coming down a heck of a lot. And in spite of what the market hopes and wants, you kind of look at it, we're probably at a a decent rate.
Yep.
So we'll find out. Also next week will be the Federal Reserve's meeting, which concludes on the 29th. That'll also be Powell's last meeting. We obviously have Warsh, who is going through confirmation hearings and proceedings right now. But there's a couple flies in the ointment that, we don't need to go into right now, but that'll be an interesting thing. But just based on looking on this there, it's like rates are probably right about where they should be. All right, CapEx supercycle. This is a very interesting thing. As you go into this, I'll just point out a quick thing that Gartner Group, for those of you who don't know, they are a global IT research firm, and their guesstimate for tech spending globally this year, it's up 14% to 6.3 trillion. 6.3 trillion represents about 5% of global GDP. Big number. So why don't you talk through what we have here on this chart?
Yeah, so this is a study that we looked at, looking at previous kind of large infrastructure build-outs. In this case, we highlight railroads, interstate highways, the Apollo program, and the broadband build-out in the kind of late 90s, early 2000s, compared to today's AI CapEx build-out. All of the figures here are in today's dollars to make kind of apples to apples. And what we've found is that the AI build-out, as it kind of currently stands to be estimated over the next few years, looks like it'll be the largest kind of capital expenditure in today's dollars of any project basically ever. Obviously, something like the railroads took 85 years to build out, and it was almost 900 billion again in today's dollars in kind of cumulative spend over that period. What it looks like today, and this is just looking at kind of the 5 large hyperscalers, it's your Google, Meta, Amazon, Oracle, and Microsoft, what their annual capital expenditures are. So a large portion of those are going towards the data centers, but also other kind of just broader AI training, broader things regarding their businesses. But it's a good measure to kind of look at real live estimates. And then this is also using estimates out to 2028. So looking at that cumulative spend from basically 2022 to 2028, those 6 years, it's going to be right around 3 trillion estimated. And that's come up aggressively over the past even 12 months. Every earnings report, the capital expenditure forecasts or what management says they're going to be, it continues to move up. And I think from our perspective, it's trying to find the beneficiaries of the spending, and then also the downstream beneficiaries of AI. Where do the productivity gains show up? Where does the actual spending show up outside of just like the hard nuts and bolts?
Yeah, the other thing that's very apparent that jumps off of this here, as you mentioned, the railroads, 900 billion over 80 years. Then you moved into the 50s when you had the interstate highways, which were almost 700 billion over 40 years. Then you had the Apollo program in the 60s that was 250 billion over 15 years. And then you had broadband in the 90s that was 3 trillion, but that was a 15-year build out. Now you're talking about AI build out at 3 trillion in probably 2/3 of that time. So another feature that each successive technology cycle has a much shorter timeline to be able to put this money to work here. So, all right. If we look at the labor market, March payrolls were big. They were 178,000. We're still a couple of weeks away before we get the April numbers. But what we do know, and Powell said this on his last presser, He thinks the break even is actually to keep the unemployment rate at 4.3. It's probably zero new ads, zero new ads. So at 4.3%, I don't think we're going to have zero. I think we're actually going to have some increase that's going to happen. So there's a good bias that 4.3 actually goes lower. And we're starting to see studies come out now. Everyone thought that with sealing off the immigration coming in, sealing off the borders, that you would see wages go through the roof and you would see all kinds of problems, dislocations, and not enough labor. And what it shows you, that has not been the case at all, has not been the case. And what that tells you, again, is that you can't kind of look at this labor as a big chunk. There's all kinds of dynamicisms that work. There's 160 million people, and a lot of these are portable people. They can move around, they can fill in things, they can get more productive. So I think overall the labor market is actually, it's better than the headline news would let you think. And again, at 4.3%, that is low in historical perspectives. All right, this is interesting. Walk us through this here. We've got this big dichotomy between consumer sentiment, which is near all-time lows according to University of Michigan, but retail sales are doing just exactly, they're on trend line.
Yeah, this has been a kind of consistent trend of this cycle, is you've had sentiment just be really, really poor relative to actual consumer behavior. Like you mentioned, the Michigan Consumer Sentiment Survey, and we'll touch on this in a second. It goes back, all the way to the 50s or 60s. It's a long survey, and this is the most negative people have been basically in the history of the entire survey, which is shocking. I think there's reasons you can point at, but then if you actually look at actual spending, actual kind of hard data on how consumers are doing, whether it's like spending or their incomes or whatever it is, all of those kind of point to a much more positive picture.
Yeah.
So as you mentioned, retail sales on the right-hand side here, they've been running at, about 3 or 4% year over year. That's right in line with historical averages. It's a solid number. People are spending money. They're going out and buying things. Real wages, wages adjusted for inflation are running around 1%, which is, a solid number. All of these things have continued just to kind of chug along. The consumer's been resilient, but the sentiment's just been, stuck in a negative area, basically.
Yeah, I like to always say that you look at the right-hand side of this, these are actual actions. Those speak a lot louder. The other one is a free survey.
Yep.
And I'm sure the participation rates are low. I'm sure there's along party lines, there's big dichotomies. Speaking of which, I saw Gallup's poll came out for the politicians for their approval rating. It's at a mighty 10 points, 10%. Now, what's unique on that, too, is this isn't a feature that's just started here in the last few years. You look back at Gallup, and it really started happening about 20 plus years ago. So, again, I don't put a lot of, credence into those, but I do put credence into the actual numbers on the right. All right. This kind of gives you an idea. Now, you've taken this chart from, like you said, the University of Michigan, gone all the way back to the 1950. What is actionable off this is when these things are on lows, what happens with the forward stock returns?
Yeah, so you kind of have this, again, dichotomy where, sentiment's really poor, people feel bad about their situations. But if you look historically, when that attitude is like that, usually for equity markets, that is a positive going forward. And the kind of explanation there is, it's kind of the traditional buy when there's blood in the streets, the Warren Buffett kind of style of investing, or the philosophy there. You can see that in the data. Kind of every bottom in sentiment, there's a strong forward return. You can see the average is around 26% positive, up 26% over the next 12 months. Obviously hard to, you can't look into the crystal ball and see what it's going to be this time, but the trend of history is certainly suggests some strength here.
Yeah. You can also see off this, typically you get lows that are around recessionary periods, but this one was interesting where COVID was a manufactured recession, but post-COVID, this thing has continued to go down. So again, there's something in there that is not being captured. It's really fractured.
Yeah.
Okay. Productivity. This is obviously a very key piece here, and I love this chart that you've put together going back to 1860. And it shows that technology is very powerful on productivity, and productivity runs between 0 and as high as 5%. And we're only halfway, we're not even halfway up. We're at 2% right now. So we're just starting. I know that you guys in research have generated some pieces that show unit labor costs, which are highly impacted. The productivity causes that to come down, that unit labor cost. It's only running at like 2.4%. So this gets me excited when I see this. We're in the early stages of AI. We got a lot more productivity that's happening. And this is going to definitely have a positive impact on the earnings for the S&P 500 and ultimately for wages and also for people's free time. Okay, GDP. Maybe let me take this one quickly here. Just for those of you going way back in time, at the turn of the 20th century, GDP was running at 0.5%. It accelerated to 3%. That was a 5-fold increase, and the duration was 100 years, all the way up to 2000. What drove that? You had the electrification. Preceding that, you had the railroads that James talked about, that the big build out that happened. So then you had basically the infrastructure in place. Then you had electrification and the internal combustion engine. And there were a lot of other things that happened along the way there, including manufacturing. But to think about that multiplier effect that happened, and we're now, since 2000, we've been running at about a little under 2.5% GDP. So if you hear people talking about an acceleration to potentially 5, a doubling with AI being, everyone says that AI is probably the most productivity enhancing technology that they've seen. It's not a big stretch. So longer term, that could very well happen. We could go well above the last 20 years of 2.5%. There's fits and starts that happen with that, but that's kind of the scenario that could play out. All right, talk us through this. We're in the 4th year of a bull market, which will that 4th year will lap in October of this year, and then if all things, knock on wood, are going right, we go into a 5th year. So what do we kind of have for your crystal ball for the next 18 months?
Yeah, so we like this chart because it kind of puts things into perspective. Obviously, this bull market started October 12th, 2022, after that big drawdown in 2022. And you've kind of seen a similar path that's been tracking according to history. One of the interesting things that we saw, the average drawdown in the 4th year, on average, kind of the maximum peak to trough drawdown is 7.5%. And we were right in the ballpark there this past kind of March drawdown with the war in Iran. So good to see that that's kind of within the normal realm of what typically happens during this time of the bull market. Looking forward, the 5th year continues to be strong. It's up 12% on average. Again, knocking on wood, assuming we get there. But the dispersion is a little higher. That kind of 4th or 5th year is when you start to see a number of those bull markets start to end. Obviously, this is kind of a small sample size. It's eight different periods since 1949, but the overall trend is still there. There's room to run. There's plenty of kind of long-term tailwinds, which we've all been talking about: productivity, AI, earnings, etc. That suggests that the bull market will continue. And history suggests that it'll be strong.
Yeah, 2 shout outs to you. I know on that 4th year, there were a lot of people that said, oh, in a midterm election year, you could have 14, 15, 16% drawdowns. But you and the research team were quick to point out, well, we're in a bull market, so let's go ahead and take that funnel and funnel it through from all experience of midterm elections. So kudos on that. The second thing I see in that 5th year, you're right. Probably starting in summer of next year, there's big volatility that historically is kicked up, because the average, going back from history, bull markets are like 4.5 years long. And so you do get a smaller sample size.
Yep.
Okay, international, this is the dollar index, and basically the dollar this year has been flat.
Hmm.
We know last year the dollar dropped 10% in the first quarter, and that was actually all the outperformance that the All Country World X had against the S&P. It was the 10 points. And it ironically, after you had the tariff tantrum that happened, Liberation Day and the lows in the market, actually there was no
Hmm.
outperformance that happened from international versus the S&P. I think if you go to the next slide here, we've got this year to date, international is outperforming by about 4.5 points. So it still is, but it's kind of showing a little similar trend
Hmm.
again, where from the lows in March, it's starting to underperform because it had even a bigger cushion. So two questions for you. First of
Yeah.
all, I see from this picture here, it looks like we're only in the second year of what could be 5 to 7 years.
Hmm.
So maybe talk about that. And then two, do you think that we've seen all the outperformance for this year? Or are there still a few other levers that you've got or that the All Country World X has that it can outperform?
Yeah, kind of looking back at US versus the rest of the world performance, this is looking at just the trailing 1 year returns. So you can see that there's kind of these big waves, these cycles essentially that you have multiple years of outperformance in either US or international. Looking back at the 80s, 90s, early 2000s, you had a few of those. The past 10 or so years, we've talked about this a number of times. It's kind of it's been dried up where just the US has been just absolutely dominating. This is the first time in a while where you've had more sustained outperformance. Obviously, last year, international did well, largely driven by early in the year. And then this year, you're starting to see them do well again, do well again relative to the US. I think when you look at these cycles, they do have legs. And one thing that we do like about this, what's kind of setting up here in particular, it's not just the dollar. So you mentioned the dollar is flat roughly year to date. Obviously, currency effects are a large part of international returns. But what's really driving it year to date so far are fundamentals. So it's actual growth of earnings, expansion of the multiple, money going into these areas. We like the asset class overall. We think a lot of people, a lot of advisors are underweight international or even completely out of international, which I've said before, served you well for 10 or 15 years. But looking, that was 10 or 15 years ago. Looking forward, okay, what is the kind of prudent thing to do for your clients? A lot of people forget that international is, 35% of the benchmark, 35% of global stocks in terms of market cap. So it's definitely something you can't just ignore. And we think that there's room to run.
Yeah, and I'd point out too for advisors, the proper benchmark to look at for international, it looks more like large cap US
Yep.
value because it has a similar sector exposure. And based on that, US large cap value trades at 18 times,
Hmm.
where All Country World X is 14. And when you get those bull markets that you've circled here, the previous five, when you're in that bull market, those typically trade at the same PEs.
Hmm.
So you've got a discount in a PE to get to it. Emerging markets, just for people listening, emerging market sector exposure looks more like the S&P.
Hmm.
It's got the exact same tech exposure at 35%. So just something to keep in mind if you're making asset allocation changes. All right, so this is on and you can see it here in
Yep.
26. The emerging market EPS forecasted growth is 42%, driven a lot by technology, and the developed are at 15. So even 15 is, I think the S&P now, you'll see in a minute here, is like
Hmm.
19%. So you've got, if you blend those two together, you're up around at the S&P. And again, you're paying the same multiple
Hmm.
as you would for large cap value. All right, here's our spaghetti pieces that we
Hmm.
just talked about. This year, the bogey it's a lot more difficult bogey. Last year, for each of the quarterly earnings, the estimates were around mid-single digits, and most of those all came in at low double
Hmm.
digits. This year, we've got the next 12 months is at 18%. The current quarter that's being reported, the first quarter, is actually the lowest bar. It's 12. We're actually early on, we've had probably, we're approaching about 20% of the S&P that's reported. and it's coming in closer to 13.5%. So there's still room where they're beating, but it does get more difficult as the next 3 quarters are all going to be high teens. So just kind of a heads up on that.
What's funny to me, I'll just add on here. Obviously you've had the headlines about Iran, all the fears within broader markets there. Earnings just haven't really cared. They've just kind of continued to march up the page. You see all those Q3, Q4, Q2, next 12 months, all just been marching up throughout March, throughout April. It's hard to stop the earnings train there.
Yeah, and one thing that we don't have on this slide, but just for advisors to keep in mind, the U.S. with higher oil prices is fairly well insulated because we export 3 million barrels a day. We're producing 23.5 million and only consuming about 20.5. The rest of the world is China's a net importer, Japan's a net importer, Europe's a net importer. So the one tail risk for the U.S. market is that the rest of the world has more issues around these supply chains, and that would domino effect and have some negative impact on the U.S. So that's something we are watching very, very closely. Obviously, the sooner the conflict ends, the better that is for everybody. All right, why don't you walk us through the value decomposition here that you've got?
Yeah, so this is looking at kind of every sector and then the S&P near the middle there. Their return year to date, which is that kind of orange diamond, that's just the total return of the sector or index. And then looking at how much of that return came from actual earnings growth versus how much the multiple is changing. So there's kind of the two dynamics there, and then plus a dividend just on top. What you can really see, you mentioned it earlier, energy is a good example. They're obviously up 25, 30% year to date. A lot of that has actually come from earnings, which makes sense. Higher oil prices, higher earnings, higher revenues, everything that they're so linked to those higher oil prices. And then the PE discounted slightly. So net kind of up around 25%. The overall index, you can see the SPY in the middle there, up around, low single digits kind of return. But a lot of that has actually come from earnings growth. So we're just looking at how earnings growth has accelerated here up, high teens, basically percent for the year. That's been a discount in the multiple, which is a good sign to see, right?
Oh, yeah.
You want to be buying at a lower multiple. You want to have earnings supporting the growth. It'd be bad to see the other way around where it's just an expansion in the multiple with no kind of fundamental support. The last thing I'll flag is the XLK in the middle there. That's had one of the biggest dispersions where the earnings growth has absolutely exploded. A lot of that being your semiconductors, kind of broader data center build out things, and the multiple has contracted the most of any sector. So overall, it's up, again, high single digits, which is good. But the multiple has brought that back down, basically.
Yeah, and you had the same thing happen last April where tech got whacked during the 20% peak to trough drawdown, and then it came roaring back. You also can see from this what we talked about earlier, energy having 35% of this increase in earnings. All right. This is our recession watch again for those of you that aren't familiar, and those of you that are familiar. We've got 9 indicators that we try to watch, try to get ahead of what's happening, of where the puck is going. You can see from this, we've got 3 that are green. That's the yield curve, PMI, that's manufacturing, and retail sales. And then we have 6 that are kind of neutral, and a lot of those neutral actually have biases to the upside. So overall, it is still constructive. You can see at the top of that panel that when you're in recessions, there's a lot of red there. So we've got to have no red right now. Again, we don't think there's a recession out there. I think in any given year, there's a 15% chance. That's just once every 7 years, a recession. And I think if you look at any of the statistical models, they're probably right between 15 and 20% for the forward.
Yep.
Okay, last thing that we have, and then I'll flip it over to James for any concluding comments here. This is our earnings forecast and our expected range of earnings looking forward here. We have a high end of 7,700, which from the last sale, which is around 7,100, that's about 8% upside. We do think that we're probably going to have a little bit of a timeout here. Just again, you've got actual sentiment, not the one where people vote with a zero cost, but what they vote with their feet and they're investing in the market. Those have all gotten back to kind of not extreme elevations, but they're back up to levels where you need to kind of have a little bit of a timeout. But 8% is what we still think is possible between now and the end of the year. And then on the downside, we've got 6,800, which is 4% downside. We think anytime that you have a 2-to-1 favorable upside downside, plus 8% versus down 4%, that's a 2-to-1. We think that's just a favorable environment to be adding money. So we like the setup. I want to thank every advisor for the great partnership you have with Main Management. And James, I'll let you give us the concluding comments here.
Yeah, I'll reiterate that. Thank you for the partnership. I'll also say, you mentioned at the top of the webinar of the podcast, if you're ever interested in any sort of portfolio support, discussion, anything along those lines, my team and I, we've done a lot of advisor talks on kind of custom model portfolios, putting together things on the portfolio side for end clients, hoping to scale your business, make things more efficient. So, if we haven't already spoken, my line is open. Happy to kind of do any discussion there.
Great. That is super, James. And once again, thank you for all of the advisor support and partnership.
Great. Thank you.